Right now, the stock market is telling you a lie. On paper, everything looks invincible. The S&P 500 is hovering near record highs, financial news anchors are celebrating, and millions of everyday investors believe their 401ks and index funds are completely safe. But if you strip away a tiny handful of mega-cap tech giants, the rest of the market is virtually flatlining. The entire US financial system has placed a multi-trillion-dollar bet on a single technology: artificial intelligence. Tech giants are pouring hundreds of billions of dollars into data centers, specialized chips, and power grids, convincing Wall Street that infinite growth is guaranteed. But behind closed doors, a massive mathematical problem is forming. This isn't just another tech hype cycle, it is a massive debt-fueled bubble quietly holding the entire market hostage, and the clock is already ticking. To understand how dangerous this trap really is, you first have to understand the illusion of the S&P 500. Most people buy an S&P 500 index fund because they believe it gives them broad diversification across 500 of America's strongest companies. But today, market concentration is sitting at levels not seen in over half a century. A small cluster of mega-cap tech stocks now accounts for well over 30% of the entire index's total weight. When you invest in the market today, you aren't buying American business as a whole. You are buying a concentrated, high-stakes wager on artificial intelligence infrastructure. If those 5 or 6 companies keep climbing, the entire market looks healthy. But if their massive AI investments fail to deliver actual profit, the floor beneath your entire portfolio simply vanishes. So where is all this money actually going? It's called capital expenditure, or CapEx. Hyperscalers and cloud providers are projected to spend well over $1 trillion on AI hardware and infrastructure over the next few years. We are talking about custom silicon, liquid-cooled server racks, and massive nuclear and natural gas supply contracts just to keep these facilities powered up. To put that in perspective, $1 trillion is more than the entire annual US military budget. In a traditional business model, when a corporate giant spends a dollar on machinery or real estate, it expects a predictable return on investment within a clear time frame. But with AI, tech firms are spending hundreds of billions before the killer software application or enterprise subscription model even exists. They are building the world's most expensive highway system without knowing if anyone actually owns a car. This brings us to the revenue reality check. Major venture capital firms estimate that the AI ecosystem needs to generate hundreds of billions of dollars in new annual revenue just to pay for the hardware being purchased today. Yet, total current software revenues from generative AI products remain a tiny fraction of that baseline. Does this setup sound familiar? It should. In the late 1990s, during the dot-com bubble, telecom companies raised mountains of cash to lay millions of miles of fiber optic cables across the globe. Their core vision was correct. The internet did reshape human civilization, but their timeline was dead wrong. Over 90% of that fiber sat dark for nearly a decade, driving dozens of telecom giants straight into bankruptcy. The exact same dynamic is playing out right now. The technology is real, but Wall Street's expectation of instant, effortless monetization is a complete fantasy. Here is the piece of the story that mainstream financial media completely ignores: how all of this is being financed. Big tech companies aren't just spending excess cash from search engines and online stores. They are increasingly turning to corporate debt markets. High yield and investment-grade corporate bond issuance from tech hardware and power utility providers has surged. When you combine elevated interest rates with heavy debt issuance, your margin for error disappears. If enterprise adoption stalls out over the next 18 months, these companies will be stuck paying massive interest bills on depreciating assets. AI server GPUs do not last 20 years like railroad tracks or highways. They degrade, consume vast amounts of energy, and become obsolete in 3 to 5 years. The debt outlasts the hardware. Artificial intelligence is undeniably one of the most impressive technological shifts of our lifetime. But a revolutionary technology does not automatically make every stock attached to it a safe investment at any price. When corporate spending is driven by fear of falling behind rather than actual customer demand, you don't get sustainable economic growth. You get a bubble. Whether this bubble bursts with a sudden crash or slowly bleeds out over the coming years, one reality remains constant: the financial math eventually catches up. This is Finance Stadium. Hit the subscribe button, ring the notification bell, and drop a comment below. Is AI the biggest wealth creator of our generation? Or are we watching the largest market bubble in financial history?